Who invented modern economics? If you said Adam Smith, you're thinking of the 18th century. If you said John Maynard Keynes, you're getting warmer. But you're still missing the real architect. The man who actually built the economic framework governing your retirement account, your mortgage rate, your government's response to recession, and the algorithms that central banks use to set interest rates. Most people have never heard his name, Paul Samuelson. Not a household name like Adam Smith or Karl Marx. Not a public intellectual like Milton Friedman. But arguably more influential than all of them combined. At least in terms of how economics is actually practiced today. This is the story of how one mathematician economist, working in the shadow of World War II, created the invisible architecture of 21st century finance. How his textbooks didn't just teach economics, they rewrote it. And how every time you check your 401k, refinance your mortgage, or hear about the Federal Reserve adjusting rates, you're witnessing his legacy in action. This is the hidden history of the new economics. And it's time you knew about it. Here's what you probably think about the history of economics. It evolved naturally, organically, through the collective contributions of brilliant thinkers over centuries. Adam Smith gave us the invisible hand. David Ricardo explained comparative advantage. Karl Marx critiqued capitalism. Keynes showed how governments could manage recessions. And somehow, gradually all these ideas coalesced into the modern economics taught in universities, applied by central banks and used by investment firms. That's not quite how it happened. The truth is messier and more interesting. Modern economics, the version that actually runs the world today, was systematized, mathematized, and synthesized primarily by one person, working during a very specific window of time. The 1940s and 50s, that person was Paul Samuelson. Now, most people who know anything about 20th century economics know about John Maynard Keynes, the British economist who argued governments should spend during recessions. The man whose ideas supposedly saved capitalism from the Great Depression. But here's what they don't teach you. Keynes was brilliant at diagnosis but weak on prescription. He identified problems, but his solutions were often vague, contradictory, even poetic rather than precise. Keynes wrote beautifully. He could inspire policymakers with his prose. But try to extract a clear mathematical model from his general theory, and you'll struggle. Try to build a curriculum around it, and you'll find massive gaps. This is where Samuelson enters the story. While Keynes was the celebrity economist, giving speeches and advising governments, Samuelson was doing something arguably more important. He was building the machinery. He took Keynes's insights from classical economics, neoclassical theory, and mathematical physics, and forged them into a coherent, teachable, applicable system. Keynes gave us the inspiration. Samuelson gave us the instruction manual. Here's a test of Samuelson's hidden influence. Think about any major economic event from the last 30 years. The 2008 financial crisis and the government's response. The Federal Reserve's quantitative easing programs. The debate over stimulus spending during COVID-19, your company's decision to offer a diversified retirement portfolio, the algorithms that high-frequency traders use, the models that predict inflation. Every single one of these has Samuelson's fingerprints on it. Not because he invented all these specific applications, many didn't exist in his lifetime, but because he created the fundamental frameworks, the mathematical language, the analytical tools that made all of them possible. When Jerome Powell, the current Federal Reserve Chairman, uses models to decide whether to raise interest rates, those models trace directly back to Samuelson's work. When your financial advisor tells you to diversify your portfolio across different asset classes, that advice is rooted in portfolio theory that Samuelson helped develop. When economists debate the multiplier effect of government spending, they're using mathematical frameworks that Samuelson formalized. The 21st century economy isn't just influenced by Samuelson's ideas. It's built on them, literally. And yet, ask 10 people on the street who Paul Samuelson was, and you'll get 9 blank stares. That ends no. To understand why Samuelson's contribution was so revolutionary, you need to understand the world he stepped into. It's 1945, World War II has just ended. The global economy is in shambles, Europe is destroyed. The Soviet Union is emerging as an ideological and economic rival. The United States is the only major economy left standing, facing an unprecedented challenge: How do you manage a modern industrial economy without either sliding into depression or embracing centralized planning? The old certainties were gone. The pre-depression faith in self-regulating markets had been shattered. But the alternatives, Soviet-style command economies, were clearly problematic. Economists were desperate for answers. But they didn't just need ideas, they needed a systematic framework. They needed tools that could be taught, tested, and applied consistently. Enter Paul Samuelson, a young mathematician economist at MIT with a radical proposition. What if economics could be as rigorous as physics? Samuelson's big idea sounds simple now, but it was revolutionary then. Apply the same mathematical rigor that physicists use to study motion and energy to study human economic behavior. Before Samuelson, much of economics was qualitative, descriptive, even literary. Sure, there were some mathematical economists, but they were the exception. Most economic arguments were made through words, not equations. Samuelson changed that. His doctoral dissertation, Foundations of Economic Analysis, published in 1947, became the blueprint. In it, he showed how diverse economic problems, consumer choice, firm production, market equilibrium, could be expressed as mathematical optimization problems. This wasn't just academic showmanship. It had profound implications. Once you express economic behavior mathematically, you can make precise predictions instead of vague forecasts. Test theories against data systematically. Build models that policymakers can actually use. Create algorithms and computational tools. Think about the difference between a doctor in 1800 saying, "The patient seems feverish," versus a modern doctor saying, "The patient's temperature is 102.3 degrees. That's the leap Samuelson brought to economics. Suddenly, instead of debating whether unemployment might rise, economists could model by how much, under what conditions, and with what probability. But Samuelson's most far-reaching contribution wasn't a research paper or an economic model. It was a textbook. In 1948, Samuelson published Economics, an introductory analysis. At nearly 900 pages, it was comprehensive, mathematical, and systematic. It synthesized classical economics, Keynesian macroeconomics, and modern theory into a single coherent framework. The book was an instant sensation. Within a few years, it became the standard economics textbook at universities across America and around the world. It went through 19 editions during Samuelson's lifetime and has been translated into 40 languages. Here's why this matters. Entire generations of economists learned to think about the economy through Samuelson's framework. The students who studied from his textbook in the 1950s and 60s became the policymakers, central bankers, and corporate strategists of the 1980s and 90s. Larry Summers, former Treasury Secretary, studied Samuelson's textbook. Ben Bernanke, Federal Reserve Chairman during the 2008 crisis, trained in Samuelson's framework. Janet Yellen, another Fed chair, same. Samuelson didn't just influence economics. He standardized it. He created a common language and analytical framework that allowed economists around the world to communicate, build on each other's work, and apply their knowledge to real problems. When people talk about mainstream economics, or the economic consensus, what they're really talking about is the Samuelsonian synthesis, whether they know it or not. Samuelson's greatest intellectual achievement was what he called the neoclassical synthesis. It sounds academic, but stick with me, this is the foundation of everything that follows. Before Samuelson, economics was split into competing camps. On one side, you had classical and neoclassical economists who focused on individual behavior, market efficiency, and long-run equilibrium. On the other side, you had Keynesian economists who focused on aggregate demand, government intervention, and short-run instability. These schools didn't just disagree, they often couldn't even communicate. They used different frameworks, different assumptions, different methods. Samuelson's synthesis did something remarkable. It showed how both could be true. In the long run, he argued, markets tend toward efficient equilibrium, just as classical economists claimed. But in the short run, markets can malfunction due to sticky prices, information problems, and coordination failures, just as Keynesians argued. The key insight? Different timescales require different models. Microeconomics, the study of individual firms and consumers, operates on classical principles. Macroeconomics, the study of entire economies, requires Keynesian tools. This wasn't just theoretical reconciliation, it had massive practical implications. It meant that governments should intervene during recessions, Keynesian short run, but shouldn't try to permanently control markets, classical long run. Central banks should stabilize the business cycle, but should respect market signals in the long term. This is essentially the operating philosophy of every major central bank today. The Federal Reserve, the European Central Bank, the Bank of Japan all operate within this Samuelsonian framework. But Samuelson's influence isn't just in abstract policy. It's in your wallet, specifically in how you invest. Ever wonder why your retirement account is spread across different types of investments, stocks, bonds, maybe real estate funds, international assets? Why financial advisors constantly preach diversification? Thank Paul Samuelson. Along with Harry Markowitz and William Sharpe, Samuelson helped develop modern portfolio theory, the mathematical framework for understanding how to balance risk and return through diversification. The key insight: the riskiness of your overall portfolio isn't just the sum of individual investment risks. Different assets move differently. Sometimes when stocks go down, bonds go up. By combining negatively correlated assets, you can reduce overall risk without sacrificing returns. Samuelson didn't just prove this mathematically, he lived it. He was one of the first economists to argue for index funds, passive investment strategies that track entire markets rather than trying to pick winners. Today, trillions of dollars are invested in index funds. Your 401k probably includes several. Target date retirement funds that automatically adjust your asset allocation based on Samuelsonian portfolio optimization. When you're told to invest for the long term and diversify broadly, you're following advice that Samuelson helped formalize into mathematical certainty. Now, let's get to the really invisible stuff, the algorithms that central banks use to manage entire economies. Central banks face an incredibly complex challenge. They need to set interest rates today to influence inflation and unemployment months or years from now. Too aggressive, and they trigger recession. Too timid, and they let inflation run wild. How do they decide? Increasingly, through mathematical models based on optimal control theory, an approach that Samuelson pioneered in economics. Optimal control theory is a mathematical framework for making decisions over time when your actions today affect future outcomes. It comes from engineering. Think of a thermostat that adjusts heating to maintain temperature, or a cruise control system that adjusts speed. Samuelson showed how the same mathematics could be applied to economic policy. Here's a simplified example. The Federal Reserve wants to minimize both unemployment and inflation. But there's a trade-off: policies that reduce unemployment often increase inflation, and vice versa. Using optimal control models derived from Samuelson's work, the Fed can calculate the optimal path of interest rates over time that minimizes economic pain while keeping the economy stable. This isn't theoretical. The Taylor Rule, one of the most influential guides for monetary policy, is essentially an application of optimal control principles. When you hear that the Fed raised rates by 0.25%, that specific number came from a model. And that model's foundations trace directly back to Samuelson's work in the 1960s and 70s. Every major central bank in the world now uses dynamic stochastic general equilibrium models, complex mathematical simulations of entire economies. These models are direct descendants of Samuelson's vision of economics as a rigorous mathematical science. Without Samuelson, central banking would still be guesswork and gut instinct. Because of him, it's science, imperfect science, yes, but science nonetheless. Let's bring this down to earth. Let's talk about how Samuelson's ideas show up in the economic debates happening right now. When COVID-19 hit in 2020, governments around the world did something unprecedented. They shut down their economies and then pumped trillions of dollars into stimulus programs. In the US alone, over $5 trillion in fiscal stimulus. Why did they do this? Because of frameworks that trace directly to Samuelson's synthesis of Keynesian and classical economics. The logic goes like this. In normal times, government spending can crowd out private investment, a classical concern. But during a severe shock when private demand collapses, government spending doesn't crowd out anything. Instead, it prevents a downward spiral of job losses, business failures, and further demand collapse. This is pure Samuelsonian thinking. Different conditions require different policies. The economy isn't always at equilibrium. Sometimes it gets stuck and needs a push. Similarly, When the Federal Reserve dropped interest rates to near zero and began buying trillions in bonds, quantitative easing, they were applying optimal control theory in real time. The question wasn't, should we intervene? But how much, for how long, through what mechanisms? These are exactly the kinds of questions that Samuelson's mathematical approach allows policymakers to answer with some precision. Or consider international trade, another area where Samuelson's fingerprints are everywhere. When economists argue about tariffs, free trade agreements, or currency manipulation, they're often using models that Samuelson either developed or refined. His work on factor price equalization, showing how free trade tends to equalize wages and returns across countries, is foundational to understanding globalization's effects. When economists warn that tariffs will hurt consumers through higher prices, they're applying Samuelson's rigorous formalization of comparative advantage. When the World Trade Organization adjudicates disputes, the economic analysis often relies on models descended from Samuelson's work. Even the debates about whether globalization hurts certain workers, a politically charged question, are analyzed using frameworks that Samuelson helped create. His models show both the aggregate gains from trade and the distributional consequences, the winners and losers. This nuance is crucial. Samuelson never claimed trade was costless. He showed mathematically that trade increases overall welfare but can hurt specific groups requiring compensation or adjustment assistance. That's a Samuelsonian insight playing out in political debates right now. Finally, let's talk about the challenge dominating economic policy today: inflation. In 2021 and 2022, inflation surged to levels not seen in decades. Central banks around the world responded by aggressively raising interest rates. The question everyone asked, will this trigger a recession? This is precisely the kind of trade-off that Samuelson spent his career analyzing. His work on the Phillips curve, the relationship between inflation and unemployment, provides the framework for this debate. In the short run, reducing inflation often requires accepting higher unemployment. But the relationship isn't fixed. It depends on expectations, credibility, and structural factors. When Jerome Powell says the Fed is data-dependent, what he means is they re-watching how the economy responds and adjusting based on models that predict different scenarios. Those models, built on Samuelsonian foundations? When economists debate whether we're experiencing a soft landing or heading for recession, they're analyzing dynamics that Samuelson mathematized decades ago. The specific circumstances are new pandemic disruptions, supply chain shocks, geopolitical tensions. But the analytical toolkit, that's Samuelson, through and through. Here's the remarkable thing. We're now 20 years past Samuelson's death in 2009, yet his frameworks remain the dominant paradigm. New schools of thought have emerged: behavioral economics, complexity economics, institutional economics. But they're additions to the Samuelsonian foundation, not replacements. That's the sign of a truly foundational thinker. So, what does all of this mean for you? Why should you care about a mid-20th century economist most people have never heard of? Because understanding Samuelson's framework gives you power. The power to understand the economic forces shaping your life. When you hear that the Federal Reserve raised interest rates, you now understand why. They're using optimal control models to balance inflation and unemployment. You can anticipate that mortgage rates will rise, refinancing will become less attractive, and saving becomes more rewarding. When politicians debate stimulus spending, you understand the theoretical framework. In deep recessions, government spending can stabilize demand without crowding out private investment. You can evaluate these claims more critically. When your financial advisor recommends diversification, you now know this isn't just conventional wisdom, it's mathematically proven through portfolio theory that Samuelson helped develop. You can ask better questions about correlation, risk, and expected returns. When you read about trade policy, you understand the nuances. Trade creates aggregate gains, but also distributional consequences. You can think beyond simplistic pro-trade or anti-trade positions. This is the practical value of understanding economic frameworks. Not to become an economist yourself, but to be a more informed citizen, investor, and decision-maker. Once you understand Samuelson's synthesis, you start seeing connections everywhere. You realize that the debate about student loan forgiveness connects to models of fiscal multipliers. How much economic activity does each dollar of spending generate? You see that discussions about cryptocurrency relate to questions about what gives. Money value questions that Samuelson analyzed through monetary theory. you understand that arguments about whether the economy is overheating involve concepts like the natural rate of unemployment and potential GDP concepts Samuelson formalized. These aren't separate issues. They're manifestations of the same underlying economic dynamics that Samuelson spent his career mathematizing. Seemingly disparate news stories about housing prices, stock market volatility, international trade tensions, central bank decisions suddenly reveal themselves as interconnected pieces of the economic system that Samuelson mapped. This is what economic literacy really means, seeing the invisible architecture beneath the surface chaos. But let's end with a look forward. Is Samuelson's framework still relevant for the challenges ahead? Climate change, technological disruption, artificial intelligence, cryptocurrency, aging populations, inequality. These are challenges Samuelson never directly addressed. Yet his foundational approach using mathematical rigor to analyze trade-offs, incentives, and equilibria remains essential. Economists studying climate change use cost-benefit frameworks descended from Samuelson's work. Analysts modeling AI as labor market impact use general equilibrium models that trace to his synthesis. Cryptocurrency theorists debate questions about money and value that Samuelson formalized. The specific applications evolve. But the methodology, the insistence on rigor, on testable models, on mathematical precision, that's Samuelson's enduring legacy. There's also a cautionary tale here. Samuelson's mathematical revolution made economics more powerful but also more technocratic. It sometimes obscured value judgments behind equations. It occasionally privileged elegance over realism. The next evolution of economics needs to preserve Samuelson's rigor while incorporating insights from psychology, sociology, history, and ecology. It needs to be mathematical without being mechanistic, precise without being blind to its limitations. That synthesis combining Samuelson's rigor with a broader, more humble understanding of economic systems, that's the future. But it's a future built on foundations that one man, working in the shadow of World War II, painstakingly constructed. Paul Samuelson died in 2009, at the age of 94, having witnessed the 2008 financial crisis that tested his frameworks in the most severe way since the Great Depression. The models held up. Not perfectly, no model ever does. But they provided the language and tools that policymakers needed to respond. When you hear debates about economic policy, when you make investment decisions, when you try to understand why interest rates rise or fall, inflation accelerates or slows, you're engaging with Samuelson's legacy. Most people will never know his name. But everyone lives in the economic world he built. The next time you check your diversified retirement portfolio, or hear about the Federal Reserve adjusting interest rates, or read about fiscal stimulus debates, remember, you're seeing the hidden architecture of modern economics. You're witnessing Samuelson's legacy. And now you know where it came from.